Hello guys, this week we're going to talk about the second part of valuation, especially merger acquisition valuation. Last time we have talked about the discounted cash flow methodology to value MA. So the second part is just briefly talking about some kind of implication for the MA valuation. For example, we're going to discuss what determines the MA premium, what determines the shareholder valuation effects on merger acquisition. And that's the second part. And first of all, we're going to look at the kind of macroeconomic environment and acquisition prices. Especially, we're going to focus on the interest rates. So basically, like previously, when we talk about MA valuation, right, we are saying that we're going to use the DCF model. And then in the DCF model, a key input there is a discount factor or discount rate, right? So then, another type of thinking about this discount rate is this is weighted average of cost of capital, right? So then it obviously will be affected by the interest rate environment, right? Because the interest rate environment in the macroeconomic situation, they are gonna affect the cost of debt basically, right? I mean, if the interest rate environment is favorable, meaning that the market interest rate is lower, then the cost of debt will be lower, right? So then that lowers your overall weighted average cost of capital, which is your discount factor, right? That's kind of the idea. So low interest rate tend to result in lower discount rates, right? So now you can see, in general, low interest rate environment is a good thing for merger acquisition because you can see it will result in higher valuation of companies, right? So basically, the short-term fluctuation of these interest rates might not change the discount rate that people use in the valuation, especially the DCF valuation model. But the changes in the long-term rates that persist for extended period of time will have an influence, right? Because remember, when we do MA valuation, we project the valuation into the future, right? We're saying that there are two stages, right? In the first stage, there's a high growth stage. After that, there will be a forever stable growth stage, right? So the discount rate or the interest rate are gonna affect this discount factor, definitely, right? So as the average yield on the long-term treasury bonds declines, the average acquisition PE multiple are gonna increase, right? Basically, it will when you calculate those price, right? When you calculate those price, it will look higher because the discount factor, well, the discount factor is lower, right? That means the valuation, the firm value is high. Firm value is higher, the value per equity, the value per share will be high, right? So that's kind of the idea. Now, then let's get back to the DCF model, right? So one of the disadvantage of DCF model, which you might realize already, is that there's no way you could change the value kind of in between the project period, in between the firm valuation period, right? So the weakness of this DCF model is that there's lack of flexibility. So you cannot really modify the value in between, right? You suppose there's a constant growth rate, then the model just moves on. You can also say at the 8th year, the growth rate doesn't hold anymore. I want to modify the value, right? It's not possible in the DCF model. So that's why DCF model cannot incorporate various options during the life of the capital investment, right? And many of these options, they're meaningful for the firm's value, right? So here we're gonna talk about one concept which is called a real option. So real options are those options that allow for modification of the value of the investment over time and are referred as real options. Now, for example, when you value a firm, if you do a DCF valuation, you just, there's no there's no much acquisition opportunity there, right? You just value this company, right? Assuming there's a constant growth rate. And the company is supposed to run forever. But in reality, we know that that's not true, right? I mean, at some point of in time, managers have the choice of going for merger or not, right? So this choice, this option, will change the value of the investment, right? So this is what the real option will capture, right? And especially in the context of merger acquisition, these options could be postponing a proposed acquisition, right? Or selling off all of a division, right? So this is the option managers have. But if you do this DCF valuation, it's not going to capture that, because in DCF valuation, there's no way you could embed those options, right? So the difference between real options and the options or financial options that we see in the real world is that an option, a financial option, gives the holder the right to buy or sell an asset over a specific time period, right? And real options are those related to real assets as opposed to financial assets, right? Just like financial options that are tied up to financial assets, right? Financial options that are tied up to stocks, right? Common stocks. But real options they're related to real assets, right? Because it's related to where to sell the asset, where to go, how with the merger, etc. Right? So the M&A process has embedded many options, such as the right to accelerate growth by combining businesses, right? Whether you want to take the deal or not, right? Or terminating projects and the setting off division, right? These are all the options this M&A process entails. So this table is going to show what are the methodology we're going to use if we want to model this merger acquisition opportunity or merger the company as using the real option valuation method. So this table on the left-hand side, this is the call option parameter. So this is the call option parameter for the Black-Scholes model. Right? So in option pricing model, these are the parameters, right? For example, in order to value option, you need to have the underlying stock price. Right? You also need to have the exercise price, right? And the volatility of the stock price, right? And the risk-free rate and the time to option expiration. These are all the important elements you need to take care when you value an option. Now, as a corresponding valuation method, if you want to value this company, value this investment opportunity, or value this merger acquisition using the real option approach, the formula you're going to use are a similar way, but it's just that you're gonna input into different variables here, right? For example, instead of having this underlying stock price, then you're going to replace it with the present value of future cash flows, right? And I mean, which is intuitively it's just the stock price, right? Because the value of a company is essentially equal to the present value of the all future cash flows, right? And the exercise price, the investment, right? It's the investment we're gonna decide on whether to go for it or not, right? And volatility of the stock price will be the volatility of the cash flow, right? Risk-free rate doesn't change. Finally, time to option expiration. This will be the time to end of relevant business period. Right? So this is kind of saying, I mean, it's just like a financial option, right? It's just like there is an underlying present value of the future cash flows, right? I mean, if you do not take the project, that's the present value of the current present value of the future cash flows, right? Now, there's a future point of in time. You can take the project or not, right? So just like you can exercise the option or not. So if you're gonna take the investment, right, then you are just like exercising the option, right? And there's a time between now and the time you take up the project, right? So this is the time to the end of the business period, right? So we're gonna use a similar way to measure, to kind of value a business opportunity or measure M&A, right? So this is the real options. I mean, this is the real option. This is the option formula we used in the option pricing model. And we're gonna use a similar one, right? It's just exactly the same. It's just that the parameters here is different, right? So I'm not gonna go into detail because I'm just gonna tell you that there's an alternative way to value merge acquisition, which we will not focus on it heavily, right? Now, the difficulty part, as you see last time, is the valuation of target's equity, right? It's a more challenging part of the process. So bidder might make adjustment to the target firm's current market price to get a reference price, right? For example, they might look at the stock price of the target firm in the 1 month or 6 months before the MA announcement, right? So it has the reference price, right? They will also look at, for example, the 52-week high of the target firm, right, as the reference price. So one adjustment would be to use the historical average price. Right? That's one reference price people can use. Now, then so I mean, last time we talk about, for example, you can use DCF model to value a firm, to calculate the firm value first, right? And then you take out the market value of the debt, which are left is the equity value. But in real life, in like real merger acquisition negotiation, the value of the equity depends on lots of factors, right? For example, the liquidity. Right? The broader the market, the greater the daily trading volume, the more liquid the security, right? So liquidity essentially means how easy you can sell or you can trade your security with other partners, right? So in that case, if you have a big market, then the stocks are liquid, right? If you have a high trading volume, then the security is also liquid, right? So here, the thickness of market or whether the market is broad enough, right? The thickness of the market, it's a major determinant of the liquidity of the security, right? If the market, so basically, so what is the thin market? A thin market means that there are not many traders out there, right? Right. So if there is a like thick market, that means there are lots of market participants, right? So the lack of liquidity is another element of the risk that must be factored into the stock price. So when you look at a stock price, right, it's just not, I mean, there are lots of things you need to consider, right? For example, whether the stocks are liquid or not. Because when you consider buying the shares of the target firm, we are saying millions or even billions of shares, right? In that case, liquidity matters, right? Because if the stock is illiquid, that increases your cost of buying the target stock. This is the kind of important part here. And the market signals can be judged by looking at the number of float shares, right? Basically, the number of shares available for trading. So when the number of float shares is small compared to the total shares outstanding, the valuation provided by the market might not be very useful, right? So a related influence on the price the buyer may be willing to pay for security is then the concentration of security in the hands of certain groups. So if it's concentrated on like arbitrageurs or concentrated in a couple of dealers, right? Then it's not very liquid, right? Because there are not many people who's holding the stock. Right? So now let's look at the equity holder valuation effects of MA, right? So many of these research studies that focus on the equity holder valuation effects, like for target shareholders, for acquired shareholders, they consider the impact of bids over a relatively short window, right? Which could be several months before or several months after the merger acquisition, right? I mean, you might argue that this window is too short, right? For example, the synergy might take years to realize, right? But there's a good reason for it. The reason is that the market has the long-term experience of many prior acquisitions. So just from the market reaction, you can already guess the market's assessment of the long-term prospects of the deal. This already tells you many things, right? Because the market is experienced, right? Second thing is the market, when it evaluates the bids, evaluates the merger position, it draws on information when it draws on the past information, historical information when evaluating bids. Yeah? And another reason for why we focus on the short-term windows because it's very difficult to conduct long-term study. Right? For example, if you look at 1 year, 2 years, 3 year, fourth year, fifth year after the merger, lots of things are happening out there. Right? It's really hard to say whether the performance change after the merger acquisition is due to the merger acquisition or due to the contemporaneous changes that happen to the firm. That's just very difficult. We can only focus on the short window around the M&A deal. So there are 5 general conclusions we get from this study. First of all, the target shareholders, they earn positive returns from merger agreements. Right? So several studies, they have shown that for friendly negotiated bids, target common stockholders, they earn statistically significant positive and normal returns. Right? So usually it's good news for the target firm. Second, target shareholders, they may earn even higher significant positive returns for tender offers. Well, tender offers is even better for target shareholders. Right? So, for example, this paper Bradley decided Kim, which you mentioned previously, they find that target common shareholders of the hostile bids that are tender offers also receive significantly positive returns. Right? The idea is that tender offer, or especially tender offer with hostile bids, right? It's gonna increase the competition, increase the pressure for the acquirer to convince the target that this is, that the acquirer really want to buy the target. The third conclusion here is that the target bondholders and the preferred stockholders, they gain from takeovers, right? Both target preferred shareholders and bondholders, they tend to gain from being acquired. Right? And the fourth conclusion is the acquiring firm shareholders, they tend to earn 0 or negative returns from mergers. Right? So this is not very good news for the acquiring firm, right? For example, acquiring firm shareholders, they tend not to do well when their companies engage in acquisitions. Finally, acquiring firm shareholders, they tend to earn low or no returns from tender offers. Right? Returns to acquiring firm shareholders, they following hostile bids are not impressive. Right? So this is the 5 general conclusions here. And when we look at the acquiring firm return, there's also the deal anticipation effect. So first of all, like we just talked about, right? The bidder returns, they're often 0 or negative, although sometimes they're very positive, right? And this paper by Tsai, Song, and Walker in 2011 find that bidder returns were related to the length of the period of time when there was no merger acquisition in a given industry. And what they also find is that the greater the surprise, the higher the bidder returns. Right? So the first bidder in the industry that had no merger acquisition before, right, enjoyed positive announcement returns of 0.69%. But there is a deal anticipation effect here. Right? So because if the investors do not anticipate there will be a deal, but there's a deal coming up, there's actually a deal coming up, then this is a great surprise. Right? And in terms of the bond valuation effects, this paper by Billy King and Moore finds that high yield bonds issued by targets earn positive returns. Right? The explanation we have talked before, that is because of the co-insurance benefits. Right? Because you can also think about that as the financial synergy, right? If you have a combined firm, then the financial synergy is higher, right? So if the firm is bigger, that means the default probability is lower. The company is safer, right? So that's why the bondholders' debt is also safer, right? So that's why there's a co-insurance benefits. target bondholder returns, they were higher when the target's rating was below that of the acquirer, right? So there's a boost in terms of targets holdings. Now let's move on to talk about takeover premium. Right? So one way to assess the offer is to examine the magnitude of the control premium. So like we talked about at the end of last time, right? So we are saying that the two components that determine the premium, right? So the first part is the control premium, which assumes that if the target firm is optimally managed by some managers, right? Then what is the premium, right? This is the first part. Second part is synergy. Right? Suppose two companies merge, the cost savings or revenue enhancement, what are the value of the synergy? What are the value increase in the synergy, right? So basically this control premium refers to the fact that when a buyer buys a controlling interest in a target company, it basically receives two benefits. The first one is the investment features normally associated with ownership of a share of the stock, right? The second thing is the right to control and change the company's discretion or direction, right? This is a control premium. So like we talked about last time, right? So one thing about the control premium is that after the control premium, maybe the acquired firm will be able to raise the leverage or change the capital structure of the firm, right? So this figure shows the controlling versus premium, right? So this is the control premium, the percentage of control premium, which are pretty high. Our average is about 40 or 50%, which is pretty high, right? So the magnitude of the acquisition premium is often attributed to the combination of bidders' estimate of the acquisition gains and the strength of the target's bargaining position, right? For example, if it's a hostile takeover, of course the target's position will be stronger. So this will affect or even strengthen the takeover premium. Second, the acquisition gains may come from a variety of sources, right? Including the anticipated synergy benefits, right? And also the control premium. So the control premium here is, for example, the fact that the target is poorly managed, right? And also the target, for example, is being underpriced, right? This is the acquisition gains. The bidder's bargaining position may also be affected by several factors, right? Including the presence of other bidders and the strength of the target's anti-takeover defenses, right? So next, so what determines the premium, right? So does the target size affect the premium, right? For example, does small firm enjoy a high premium or not, right? So here, if the target firm it is small and has some valuable technology or intellectual property, then an extra high premium could be justified. So indeed, actually, people find that for smaller targets, they do receive high premium, right? For larger targets, premiums are lower. Because one of the theory here is that smaller targets, they are easier to integrate and smaller deals are less risky, right? Because if you have a big company, you have many divisions, the integration process is very painful. Now, we also talked about another type of merger previously, which is the merger of equals, right? Now, if the transaction is a combination of two companies that have similar sizes, and when neither of the two companies really acquiring the other, so there could be argument that there's no basis for a premium, right? Because I mean, they have similar sizes, right? One example is the 1998 merger of GTE Corporation and Bill Atlantic, right? This company is later the Verizon company. So if the transaction is considered an acquisition by Bill Atlantic, then the GTE will end up paid, right? Because only 1.22 shares of the Bill Atlantic for each share of their company, right? GTE shares closed at 55.13 shortly after the deal was announced, right? Whereas Bill Atlantic shares closed at 44.32. Right? Obviously, you can see GTE, they were underpaid, right? So if you think about the fact that the GTE has a high P ratio, for example, right? A faster revenue growth and a share price that was as high as $64, then the offer was not impressive from GTE's point of view, right? So, but at that time, GTE, this company's management, they defended the deal as a merger of equal. So they don't think that the deal will generate a high premium for the shareholders. And this is actually consistent with Delaware Cut's position, because in this acquisition, you can see this is a stock for stock transaction, right? That's why there's an exchange ratio here, right? So 1 share of GTE stocks is exchanged for 1.22 share of a Beal Atlantic share, right? That's why it's a stock for stock transaction. In general, the Delaware Cut thinks that stock for stock mergers, there are no changes in control. That's why, based on this legal view, so you cannot justify a control premium here. Finally, let's look at manager incentives for those MA premium. There is a moral hazard problem here, which we actually talked about earlier. So the CEO of the target company, they're supposed to be negotiating the best deal for shareholder. But by the same time, these top managers, they're also negotiating their own best compensation package and position in a combined company. You know? So this paper by Julie Wolf, she finds that indeed CEOs do trade power for premium in such negotiation. And this is actually particularly worse in merger of equals. Right? Because if it's a merger of equal, that means you can potentially maybe get a similar position in the combined company, right? Because you are a similar sizes to the two merger partners that have similar size, right? But if a large company acquires a smaller company, right? The smaller company CEO, they cannot expect to get a similar position like a CEO in a large company. Right? So that's the logic here. So actually, so this is actually the kind of general finding, which is CEO, they all have this kind of incentive, which is to sacrifice the shareholder value, right, for their own private benefits, right? For example, they might not try harder to negotiate a high premium for the target shareholder, right? If the acquired promises them already a position in a combined firm, right? That's the idea. Now, the next question here is, does the market value control independent of takeovers? That means, when does the market value the control premium independent of the takeover? Huh? I mean, another way to put it is that, does control provides a premium in the absence of the takeover? Right? This paper examined the market prices of the common stocks of 30 companies with classes of common stock that pay identical dividends but differ significantly in their voting rights. Right? So they have two groups here. One group has significantly greater voting rights on issues related to the control of the company, whereas the other group does not have that kind of voting rights. Right? What they find is that these two groups of security, they provide the same opportunity for financial gain, right? But differ only in their voting rights. And this paper find that the average premium, the control premium, was about 5.44%, right? Which is the difference between the market returns of these two groups of companies. Right? And another question here is about the relation between corporate governance and the takeover premium. Right? The question here is, does shareholder control in a target company affect the premiums such company get in takeover? Right? On one hand, for this company there is a greater or higher degree of control by certain shareholders, right? Like managers, right? In that case, it will increase the takeover premium, right? Because if the manager are like controlling the firm, right, they will try to fight, right? If they want to fight, then the only way to make them not fight is to pay them higher. Right? But there's also the opposite side, which is the controlling shareholder could oppose takeovers, right, so as to preserve their control value, right? Because they can object to the merger acquisition in the shareholder voting, right? They say no to this deal. In that case, they can still have the value of the control of the company. So this paper by Moller 2005 finds that in the 1980s, the period of the fourth merger wave, target shareholders' control and the takeover premiums, they were negatively related. Right? And direct shareholder control in the hands of large block holders can have a positive effect on premiums, right? Because these shareholders, they push to get the highest return for their investment because they're large block holder. On the other hand, if those those very high shareholder ownership, they are coming from managers, right, such as the CEO, then they can have opposite effect on takeover premium because CEO, they tend to value their control rights very high. That's why they might oppose to the takeover offer. Right? That's why they might have opposite effect on takeover premium. So let's also consider the impact of prices on takeover. Right? So this is about whether the target company is undervalued or not in merger acquisition, right? So if a given target stock is priced lower by the market, then its probability of being taken over is greater. Well, for example, undervalued target is more likely to be acquired, right? The main reason is that previously we talked about hedge fund activists, they also play a role in the merger acquisition process, right? These hedge funds, they search for companies with valuable assets and possibly bad management where the stock price has fallen. Right? And they often accumulate shares in such companies and agitate for changes, right? So that's why if a target company is undervalued, then they are at the risk of being bought over, right? Especially at the risk of being attacked by hedge funds. Right? This paper by Kramer, Nye, and John, 2009, and also this paper by Bates, Behr, and Lemon, they find that there's a negative but statistically insignificant relationship between the takeover probability and the Tobin skew of the company. Right? So, which says that if company's Tobin skew is high, that means the valuation is high, then you are less likely to be acquired. Right? I mean, essentially because there's not much gain acquirers can get by acquiring you. Right? Another paper by Adams, Goldstein, and John find that the prices of the potential targets are endogenous actually. Right? For example, when a stock price of an otherwise valuable company falls, the market recognizes that it is becoming a more attractive takeover target. And this by itself increases demand for the shares, right? Therefore, offsetting some of the price decline. Right? And in general, there are three things we need to be aware of when we value the stock for stock offer, like stock merger. First is the tax incentive. Second is the risk effects. Finally, there is the shareholder wealth effect. So first of all, in US, the tax laws provide that the stock for stock exchanges, they may treat it as tax-free reorganization. So you don't have to pay tax on this type of merger, on the consideration you receive, for example. Right? Stocks that a target shareholder they receive will not be taxed until the shares are sold. Right? When the shares are sold, they are considered capital gains, right? And in typically capital gains, they are taxed at a lower rate. Right? And therefore, the target shareholders, they are able to postpone being taxed on the consideration until the new shares in the acquire are sold. There are also other tax advantages not in stock transaction, but in cash ones. For example, because we're talking about the tax advantage of a stock for stock transaction, right? It seems like, or maybe there are no tax incentives at all in cash offers, right? But there are, right? So, for example, in the cash acquisition, there is the ability to set up the asset base or utilize unused tax credits that the target might possess. This we talk about in the very first part of the class, in the topic one, right? So this is tax incentive. The second one is risk effects, right? The risk effects here is in cash deals, target shareholders immediately realize their gains. Right? Acquiring firm shareholders, they assume the risk that synergy gains will offset the premiums paid and other costs of the acquisition. Right? So that's why stock acquisition might be risky. Right? Because the stock price, they're changing rapidly. Right? So finally, let's look at the shareholder wealth effects, right? For target company, there's the short-term effects. There are short-term effects for target company, right? For acquiring company, there are short-term and the long-term effects. Yeah. So for short-term effects, the target company valuation effects are greater for cash offers than for stock offers, right? So this paper by Huang and Walkley in 1987 find that cash offers, they are associated with substantially higher target returns before and after controlling for the type of acquisition and the amount of resistance, right? And basically, these two guys, they attribute the higher premiums of cash offers to tax effects, right? And basically, higher premiums are required to compensate shareholders for the cost incurred in cash acquisition, right? So target company, let's first look at the short-term effects, right? Short-term effects is, first of all, we already talked about this, right? So we talk about, like, if you look at announcement return, usually target shareholder, they get a high announcement return, right? This is the first, first of all, this is the short-term effects, right? And also this paper by Sullivan, Johnson, and Hudson find that higher returns associated with cash offers persistent even after offer is terminated, right? Even if this offer, this bid is withdrawn, right? This higher returns associated with cash offers, they also persist, right? They also are there after, even after the offers they were terminated. Basically, the interpretation here is the market is re-evaluating the targets of cash offers and placing a higher value on them as a result of the cash offer, right? So basically, when a bidder shows interest in the target, this tends to enhance the market's valuation of that company, right? And also it might also attract other bidders, right? So now let's turn to acquiring company. Let's look at acquiring company. Let's first look at the short-term effects for the acquiring company, right? Chang, this guy, find that abnormal returns, they were approximately zero and not significant for the cash offers of public company, right? This is not surprising given that previously, one of the general conclusions for this study is that the returns around the announcement is approximately zero and not significant for cash takeovers, right? And he also found that the returns were positive and significant for the stock offers, right? So that means cash, if the acquirer uses cash to buy other company, the market reaction is almost zero, right? But if the acquirer uses stock to buy another company, then it's usually positive and significant, right? So for private firm takeovers, returns were not significant for cash offers, but were negative for stock deals, right? This is the short-term effects. The explanation here is that there might be more monitoring when the stock is given to the few owners of a closely held company, right? So if you use the stock to buy another, let's say, private company, right? And private company is usually closely held, right? So this seems to suggest that there'll be greater monitoring, right? Because if it's a public company, your shares are very dispersed, right? So the monitoring is weaker. Now, if you use the stock to buy another private company, that means the private company might enhance the monitoring. That's why there's a positive market reaction here. And the reason why for public company, the returns are positive and significant, right? There are many explanations. One of the explanations is that usually acquired mentality of using the stock is that when the acquired stock is overvalued, right, they'll try to use it more. Yeah? So then, if the acquirer uses the stock to buy the company, it appears that acquiring shareholder, they're getting a good deal, right? Because they're using the overpriced shares to buy a target, right? So they basically pay less, right? That's the idea. Now, if we look at the long-term effects for acquiring company, right? This paper by Lorhan and Vijay, 1997, view their results from a long-term perspective, right? While this guy Chang focused on short-term announcement effects. And so these two authors, they focus on long-term effects of acquiring company, right? For example, these two authors find that over the 5-year period following acquisition, right? This is the long-term period. The stock deals, they have average negative excess return of negative 25%. Whereas for cash tender offers, the return it's very, very high. It's like positive 61.7%. This is the long-term effects, right? So now, and related to the question I just mentioned here is that why, I mean, usually when an acquirer uses the stock to buy the company, this is usually because they are using overvalued shares to buy the company, right? So this paper, Schleifer and Vishny, 2003, they find that overvalued companies, they have the incentive to use their equity to acquire valuable targets, right? In doing so, they're able to convert their overvalued shares into hard assets by acquiring other firms. So one of a very notorious example here is the acquisition of Time Warner by AOL. Now, like I said in the first class, right, this was the worst merger in the history. And it was the worst merger in history because AOL was using the temporarily overpriced shares to basically acquire Time Warner and its valuable businesses, right? But at the end of the day, the stock prices of the AOL revert to its intrinsic value, right? So that's why the deal actually failed, right? And when a company's stock is overvalued, it will be reasonable for the market to correct this overvaluation, right? This paper by Sayer and Liu find that the greater the overvaluation, the greater the incentive to merge, right? So which is the incentive to acquire. So because their shares are overpriced, right? They want to take advantage of this and then engage in buying another company. So this paper also finds that abnormal returns for failed acquirers underperform their successful counterparts by 13.6 per year, right? And 22 and 31 for 3 years, right? So this suggests that the failed acquirers have substantial underperformance right, relative to the successful counterparts. Basically, the unsuccessful acquirers, they suffer weak abnormal returns after the bid collapsed. All right, so this already tells you something, right? Because the fact that the bid collapsed means that the market is starting to correct this overvaluation of the acquired company. For the successful acquirers, on the other hand, they were able to exchange their overvalued shares for the hard assets, and the market responded to this positive move, right? So like we just said, right? So if there's a public company using the stock to buy another company, the acquired shareholder, the market thinks that the acquired shareholder has a good deal out there. Now let's move on to the cash acquisition, right? So in recent years, the companies in the United States, they have been holding increasingly large amounts of cash, right? For example, Apple, right? Apple has a lot of cash. The value has reached 2.5 trillion. Right? Companies have been generating significant cash flows as the economy expanded, but some of them are reluctant to make long-term investments, right? Because recently we are still after the subprime crisis and the Great Recession, right? So firms are still afraid to make investment. So because if they wanted to make investment, they have to lend, so they have to borrow, right? So that's they are still afraid of doing that. And another reason for retaining the cash holdings is that there's a high corporate tax rate in the United States, which means if they want to do a cash acquisition, they have to pay a high tax. Right? And this paper by Harvard 1999 finds that cash-rich firms are more likely to conduct merger acquisition and value-destroying acquisition. Also, this actually related to, if you still remember, the incentives of doing leverage buyout. Right? One of the reasons is that when companies has lots of cash, this will create a free cash flow problem, right? Which is essentially the kind of source for agency conflict, right? Managers will use those cashes to make unwise investment, make very bad investments, right? And he also finds that these firms, they tend to do more diversifying acquisition, So managers are more likely to use stock when there is information asymmetry. That's also another reason, right? Because I mean, if you use cash, there is no information asymmetry, right? If our agreed upon price is 1 million, right? 1 million is just 1 million, right? But if you use a stock, then you don't know. I mean, you don't know whether how much is the. I mean, there is uncertainty in terms of the valuation of the target company. There's also the uncertainty in terms of the valuation of the acquired company, right? So that's why managers, for example, acquiring managers, they will try to take advantage of this information asymmetry to use the stock. Right? For example, acquiring manager know the intrinsic value of the company, which might be well below the current market price, of their stock, right? But target shareholders, target managers, they might know, they might not know about this, right? So that's why acquiring shareholders, they might take advantage of this and they use the stock. So because manager, director, they are insiders, right? That's why they're in a better position to evaluate the market's attempt to value the company's expected profits and returns, right? So the market is also aware of the significance of managers' announcement to use stock to finance the deal. So in general, market will take this as a negative signal that the management believes the stock to be overvalued, and the stock price of the bidder should weaken when the deal and its financing choice are announced. So, which says that maybe in the 1 or 2 days around the market reaction, around the deal announcement, the market reaction is positive. But then after that, it reveals the fact that the acquiring company is overvalued, right? Then they will start to kind of adjust. The market will start to adjust the valuation of the acquiring company. This paper by Amihud et al., they find that the cases where there were negative bidder returns occurred when manager ownership was low, right? So when the manager ownership was high, there's no negative market response, right? So there are kind of conclusion here is that the market is thinking that when manager ownership is high, the deal is at least non-value reducing, right? So because when the ownership of the manager they are high, then their manager's interests or manager benefits they are pretty much aligned with shareholder interests, right? So that's why market is not afraid of this phenomenon. Right? Now let's go one more step ahead, right? To look at the exchange ratio in the stock mergers. So the exchange ratio, we actually talked about this just previously, right? So the exchange ratio is basically the number of the acquired shares that are offered for each share of the target, right? The number of shares offered depends on the valuation of the target by the acquirer. Right? For example, these two companies, Alcatel and Lucent, they announced a stock-for-stock merger where each Lucent shareholder will receive 0.1952, right? This will be the exchange ratio, right? Of an Alcatel American depository share for each share of a Lucent they own, right? Both the acquired and the target conduct valuation of the target. And from this process, the acquired determines the maximum price it is willing to pay, while the target determines the minimum it is willing to accept. So that will be a range, right? So we talk about this range actually in the first class. That would be a minimum exchange ratio. That would be a maximum exchange ratio. And based on the valuation of the target, the acquired determines the per share price it is offering to pay. And this exchange ratio is determined by dividing the per share offer price by the market price of the acquired shares. This is the exchange ratio. Now let's look at one example. We have two companies here. One is United Communications, the other is Dynamic Entertainment. And this is their present earnings. This is their shares outstanding. This is EPS per share. This is EPS, right? For United Communications, the EPS is 10. For Dynamic Entertainment, this is 5, right? And the stock price for United Communications, it is 150. For Dynamic Entertainment, it is 50, right? And then the PE ratio is 15 for United Communications. The PE ratio is 10 for Dynamic Entertainment. Right? Now let's first look at how to calculate the exchange ratio here. So let us assume that based on the valuation of the dynamic, this acquired United Communication has determined that it is willing to offer 65 per share for the dynamic. Now, if you compare it to the market price, the current price of the dynamic, it is 30% premium over the pre-merger market price of dynamic, right? Because the pre-merger price is 50, right? And in terms of United shares, the 65 offer is equivalent to United's 65 divided by 150 share, right? Now, this 65 is the offer price from the acquirer, right? And the acquirer's stock price is 150, right? So that's why the exchange ratio here is the offer price divided by share price of the acquirer, right? Which means the exchange ratio is this United Communication, which is the acquirer, uses 0.43 share for 1 share of the target, which is dynamic. Right? That's kind of the interpretation here. United Communication can calculate the total number of shares that it will have to offer to complete the bid for 100% of Dynamic Entertainment. Right? And how do you calculate this total share? This total share will be the offer price divided by the total outstanding shares of the target. Oh, sorry. The offer price times the total outstanding shares of the target divided by the price of the acquired, right? Which is 65 times the dissonant number of shares outstanding for the target, right? And then the acquired price is 150, right? So this is the number of shares for this is the total shares that the United Communication will have to issue, right? Now we can evaluate the earnings per share before the merger, earnings per share after the merger for the United Communication, this company, right? We're interested in comparing the EPS because there's one thing that both acquire and the target managers, they are very concerned of when they actually negotiate a deal, which is called EPS dilution, right? So the idea is that if the acquisition will dilute the EPS for the acquirer, usually acquire manager they don't like it, right? Because they will prefer a deal where the EPS of the acquirer is not diluted, right? So that's why we're going to look at situations when the EPS will be higher and situations when the EPS will be lower. In other words, will be diluted, right? So let's first calculate the post-merger EPS here. The post-merger EPS of these two companies is, first of all, the combined earnings of these two companies, right? We are doing a very simple example here. Combined earnings of these two companies. Then we're gonna calculate the total shares outstanding here. So again, this is the shares issued by United Communication. Total share they have to issue, right? Plus, this is the number of shares for the acquire, right? This is the shares that acquire has to issue, right? So then in that case, the pre-merger EPS is $10 for the acquire, right? Then the post-merger EPS will be combined earnings divided by total share outstanding, which is 10.23. Now in this case, you can see the EPS of the acquired has been enhanced, right? That's kind of idea. Now let's assume that this dynamic or this target company, it rejects the first offer of 65 per share. And they reject it because their own valuation of the target company is $65 per share. Right? And the target company, the Dynamic, also believes that its value to United is well in excess of 75. And then based on some hard bargaining, this acquired company put up this new offer, which is much higher than before, right? The $90 new offer. So let us suppose that the target firm rejects the offer because it has own valuation, thinks that the company is worth 75. right? And then the target firm also believes it's well in excess of 75. So then finally, based on some bargaining, the acquirer raises the offer price to 90. So in that case, we can recalculate the exchange ratio. So denominator it is still the same, 150. But the thing that only changes is the offer price. Right now it's 90. So now the exchange ratio is 0.6, meaning that 0.6 shares of acquired stock will be exchanged to 1 share of target stock. That's the idea. Then we can again recalculate the total shares that acquired has to reissue, which gives you this number. Right? So again, still the same formula: offer price times the total share outstanding of the target divided by price of the acquirer, which gives you this number. So then, using the formula here, right? So use the same calculation above, we can get a post-merger EPS if the offer price is 90, right? What we get that the post-merger EPS is 9.68. So now you can see the EPS of the acquired firm is diluted, right? Because the post-merger EPS is lower than the pre-merger EPS. So this is the example of the dilution EPS. And in many cases, acquire don't like this kind of offer. Sorry, so acquire will not make this offer, right? Because essentially the idea is that acquire always want a higher EPS after the merger. So a lower EPS will create an impression that the company the combined company is not doing well. So in many cases, acquire will not make such offer to dilute their EPS. Right? The criteria for dilution EPS is that dilution will occur anytime the P/E ratio paid for the target is higher than the P/E ratio of the acquirer. So how to calculate this P/E ratio paid? It will be dividing the EPS of the target by the per share offer price. So in the first case, when the offer price is 65, right? In our case, the P/E ratio is so per share price. Let's go back. Let's look at the per share price of target. It's 5, right? EPS. So basically, we use the offer price to divide the EPS, right? Which gives you 65 divided by 5, which is 13. And this is lower than the acquired EPS, which is 15, right? So now this is when there will be a dilution in EPS. So, oh, sorry. So in this case, the P ratio paid is lower there, right? So it's not a higher there. Only when it is higher, then there will be a dilution EPS. So in the first case, there's no dilution EPS. In the second case, there is dilution EPS, right? Which is the P ratio paid is 18, right? Which is higher than the 15, which is acquired EPS. So in the case of 90 offer, there will be a dilution EPS. And also in stock for stock exchange offer, the buyer in this kind of transaction can offer either a fixed number of shares, right, or a specific dollar value. So if it's fixed number of shares, then it will subject to the stock price change, right? And if it's a specific dollar value, then the number of shares will change because the price is changing. So in our case, the value the seller received and the buyer provides then will vary with the bidder stock price movements. So in that case, the buyer can simply offer a fixed value and the actual number of shares may vary as the stock price changes, right? Because the actual number of shares is equal to the dollar value divided by the stock price. So in that case, you can see if you use a fixed number of shares way, if you negotiate based on the fixed number of shares, then there could be uncertainty. And this kind of uncertainty can be reduced using this collar agreement. And this collar agreement will set up this minimum or maximum range, right? It will tolerate small movements in the stock price, right? And there will be a threshold to be established. And many of these call agreements allow the bidder to walk away from a deal if the stop price moves higher than the range for a stop price set forth in the collar. So that's why there should be a range, right? If it's out of the range, then bidder can always walk away. Finally, we're gonna summarize what are the desirable financial characteristics of targets. First of all, the target needs to have rapidly growing cash flows and earnings, right? So this is a growing firm. And this is the most desirable characteristic because acquirers what are acquirers looking for? They're looking for external growth, right? So if the target is growing, then they're looking for what they want, right? And the future cash flow will mostly that benefit a buyer, right? Second, low P/E ratio, right? This suggests that the target should be undervalued. Uh, this is also a desirable characteristic. Yeah. So what is the low P/E ratio? It is usually compared with its level over the past 2 to 3 years. And the lower the P/E ratio, the lower the price that will be paid to acquire the target's earning power. And also low price relative to earnings, right? So this suggests that a falling stop price that is not caused by a reduction in the potential target's earning power might present a temporary undervaluation. And this temporary undervaluation is a good acquisition strategy. And acquire can measure the undervaluation by comparing the P/E ratio with the previous level or the preceding 3 years. And uh, uh, the advantage is also that if the target is undervalued, then acquiring firm by buying some of the shares, they can also benefit from buying those undervalued shares. Right? That's also another advantage. And then market value less than book value. So this suggests that basically, again, it's another way to say you should look for undervalued firm. In this case, book value is a more reliable measure of value in certain industry. For example, real estate industry, right? In many cases, market value is not useful. And also for example, industry that tend to have more liquid assets, right? Then these industry also tend to have more useful book value. So in that case, book value can be put to use as a floor value, right? So if the market value is less than the book value, that still again presents undervaluation opportunity. And also high liquidity, right? Liquidity is also very important because you need to easily buy. The target shares needs to be bought easily, right? So this target company's own liquidity can be used to help finance its own acquisition. So if you have a high liquidity ratio, it's a good reflection of the condition. And the additional liquidity is even more applicable for debt finance takeover because if you want to borrow more debt to finance the deal, liquidity is also good, right? Because you need to borrow from banks, right? To buy the shares basically. And low leverage, right? So acquire always do not prefer to kind of shoulder the debt burden of the target. That's why they prefer a low leverage ratio. Finally, we're gonna look at the evaluation research on takeovers of privately held company, right? So, which is, how do we evaluate those privately held companies, like private firms? So one study by Chao analyzed the stock price reaction to public bidding firm when they acquire private company. What they found is that bidding firms did not experience any abnormal return for cash offers, but did show positive abnormal returns for stock offers. This is what they found. And the positive returns for stock offers contrast with the research on stock acquisition public company that feature negative return. So that is, if you use stock to buy private firms, the return is positive. If you use stock to buy public firm, then it will be negative return. The one possible explanation is there could be more monitoring. Again, right? This is similar to what we have just said. This greater monitoring might reduce the agency conflict, therefore increase the value. because in private firms, then the ownership is not a dispersed. It's very concentrated. So there will be more monitoring of the CEO. So I mean, in other words, there will be more aligned interest between the manager and the shareholder. And finally, these four guys, 2008, they analyzed the sample of 1,667 deals, and then among them, about 1/4 they are private bidders, right? What they found is that public shareholder they receive a 63% higher premium when the acquirer was a public company as opposed to a closely held firm. So the difference between the private and the public acquired premium was greatest when the share ownership by management in the public company was low. So this we also mentioned the reason. The reason is that if the manager ownership is low, the incentives of the manager and the shareholder they are quite dispersed. Right? That's why that's why the um, that's why there will be a premium difference, right? So this is why we find this huge difference between the um, private and the public acquired premium. Right? Okay, this is so much for this week.